And that's the biggest thing you've just mentioned, because even with the investment side of things, people may feel like they have to start with a massive number and not realize that the way they get to a massive number in terms of how much they're investing over time is just growing bit by bit. So you might start off with even £10 a month, but over that period of time, you could end up be investing maybe 1,000, 2,000 a month, if not more, depending on how you continue your wealth journey, and just making a point to invest. Because in that same context, I will definitely be a testament to watching other people's earnings dramatically increase as they're becoming more conscious of the end in mind. So just being aware that, oh, the lifestyle I want 40 years from now has a number attached. So now all of a sudden you have more motivation, whether it's spending more energy and time in a business or side hustle he's working on, to even having the courage to ask for a promotion and extra money from the job that you work at.
Yeah, I mean, that's a really, really good point. I think as well, when it comes to finance and investing, especially within our communities, right? I think part of it is that there is a lack of awareness and education in terms of why, this is really often why there's a big wealth gap, and often there is a big wealth disparity amongst social classes, but also racial classes, right? That financial literacy piece is often missing. So often especially in our communities, we associate wealth and financial attainment through income generation, whether that's through a business you've created or through employment. But actually, often, if you actually look at the recent history over the last 20, 30 years, for instance, right, the things that have gained the most value are assets, right? So if you bought a house in 2010, very, very easy, that house could be 100% up right now, right? Like it could have doubled in value. And I know for sure where I live, for example, I think in a previous episode, we talked about this, right? When I was growing up, my best friend, I remember his parents bought a house really close to where I now live, right? And I think they bought it for like 300K, 3-bedroom house, Bermondsey area, 300K, right? That house now easily worth 600K, right? That is asset price inflation, right? And you can only get that if you are invested in assets. Wealth, on the other hand, employment, on the other hand, right? Wages have stagnated, or if they've gone up very little in that time. So that's why, like, you've got to think about investment, not just only about, making money in the long term, but it's also about making sure that you're on that kind of boat when the levels go up. It brings you up with it, as opposed to you kind of just having to bring yourself up on your own through things you create or work on.
100%. And even just thinking with the end in mind, the inflation issue, I don't think is going anywhere. So the fact that most people's price increase in terms of their salary will probably never be over the current rate of inflation, doesn't matter what the Bank of England or other institutions try and do to bring it down. The fact that's going to be a constant thing means it's even more important. Even the fact where many years ago, decades ago, should I say, you could just have your money in a bank and not do anything with it, and that was seen as a viable investment strategy. And another thing as well was we created a calculator that we're happy to share, or we will be sharing with the audience here, about what does your money look like if you just did nothing with it over a 0 to 40 year period, compared to if you just invested and generated a certain percentage annual return. So the average over that period of time may be 7 to 10%, but even then it's significantly more than what you could do if you just did nothing with it, or you was worried. Because I think that's probably the biggest issue with exit planning. A lot of people are scared with some of the different ways in which you can invest, whether it's mutual funds, index funds, stocks, trades, so real estate as well. So there's quite a few factors that I can understand would be the reason why people don't think enough about exit planning.
Yeah, I mean, I think that's a really good point.
Yeah, I love that. So we've been talking about exit planning, we've been talking about how you can make investments, especially in the stock market, from now. I mean, if you missed the 2010 wave, there's still another wave coming on, by the dip, that kind of vibe.